Welcome back. You're watching PwC, The Winning Leap, taking the discussion on the deal scenario in India forward. I have with me Sanjeev Krishan, leader private equity at PwC, and Gopal Jain, managing partner at Gaja Capital. Gentlemen, thanks very much, both of you, for joining in. Sanjeev, if we can start with you first. Last year, that is 2015, we saw about $17 billion as far as PE money into the country is concerned. Do you think this year we can top it?
I don't think so. I think we'll end up somewhere between 10 to 12 this year. I think if you see last year, there was a lot of money going in early stage companies, a lot of money going in consumer and technology based companies, early stage companies, which is not happening this year. I mean, that money is not available. Those investors are not there, and unfortunately, some of these businesses have not held up to the promise that the investors perceived last year. Aside of that, there are obviously sectors which are doing well. For instance, financial services is doing very well. Healthcare continues to have significant interest. Consumer continues to have interest, and renewables and real estate also continue to have interest. So I think we'll settle somewhere between 10 to 12 billion dollars this year.
For us to be a 20 billion a year market, I think two big things have to change. One is Indian alternatives as an asset class has to perform better, and that's linked to the exit question. The second issue is the source of our capital. Right now, Indian private equity as an asset class is completely disconnected to domestic savings. So very little of domestic savings flows into the Indian private equity asset class. Nearly 90-95% of the entire asset class is sourced from offshore investors. But if you want to take this from 10 to 20 on a sustainable basis, you have to connect our domestic savings market to this asset class.
This year and the year next, which sectors will lead PE inflow, according to you, Gopal?
The place to start is actually macro. So because macro drives everything. And everything starts with inflation. Right, so you have lower inflation, it starts off a virtuous cycle. So what do we have with lower inflation? We have lower interest rates, we have currency stability, and we have equity in general becoming more attractive than before. So as inflation comes under control, as interest rates come down, and as currency stabilizes, as equity becomes more popular, you will see again a rotation into domestic consumption. So domestic consumption driven businesses will start becoming more attractive to investors, start looking more attractive to investors. Also, lower interest rates have a profound impact on attractiveness of infrastructure as an asset class.
Okay.
Right? Because Mr. Infrastructure is actually Mrs. Interest Rates. Right? So what we'll see if this macro improvement sustains is the return of domestic consumption in terms of attractiveness.
Sanjeev, we keep hearing about big numbers waiting for exits, especially out of the infrastructure sector, as Gopal pointed out. He's talking about money going into that sector once again, private equity money. But what about the exits? I mean, just paint that picture for us.
So, I mean, if you look at exits, I think exits, we have seen a good trajectory on exits. I think over the last 18 months, whether it is by way of IPO, whether it is by way of strategic sales or indeed secondaries, I think the exits have shown a good trajectory. It's a good thing because that gives investors the confidence to plow money back, to first raise money and then to plow money back into the country. And for a capital starved nation like ours, this can only be good. So I think in fact the exit activity is great news. The only issue that I see is that not a lot of money which has gone in the infrastructure space is coming out, unfortunately. And I think that continues to be an area of concern.
A lot of global pension funds, sovereign wealth funds, they've started investing into the country in the private space, right? I mean, they've been investing in listed equities, etc. How do you see that trend developing as we go forward?
India is an attractive market in terms of yield right now. So we are living in a world which a very large part of the world is now seeing negative interest rates. And nominal interest rates in India are still high. And as the currency stabilizes, real interest rates right now look very attractive. So the principal direction of fresh interest from these large core institutional investors is towards yield in one way, shape or form. Because even investing in real estate is essentially yield investing, especially commercial. India is not a significantly large market still for large institutional investors to operate directly. You will still see them come via funds. But yes, there's a new asset class which has opened up, which is looking attractive, which is yield.
And what are they really looking at? I mean, because if you take that yield argument and you said, well, some $12–13 trillion yielding negative returns, right? So, I mean, even if a small percentage that decides to not stay in the negative zone, we're talking about very large sums of money.
The relative allocation of capital to India will increase from this very large multi-trillion-dollar pool, given the fact that our nominal and real interest rates are still fairly high. And when that is compared to negative interest rate environments, then starts looking attractive.
Sanjeev, if I can come to you, do you think many companies look for private equity investors not just for their money but also for guidance, for example, hand-holding? Are we seeing that those kind of deals?
So I think it's changing. I think if I were to look at 2006, 7, 8, I think that was a different period. I think at that point in time, companies desired only capital. I think today also there has been a generation shift, and the entrepreneur today is more amenable to working with the investors. And I think that's a sea change that we have seen over the last 10 years. I mean, if you look at the first wave of investments, big investments, 2006, 7, 8, and the one that we are seeing now, I think that's the big shift which has happened.
Any thoughts on this?
Absolutely. But you know, it takes two to tango. So in order to provide governance, business domain expertise, and operating value add, private equity firms must be capable of providing that, right? So you on one hand, you need entrepreneurs who need that, are willing to accept that they need that. On the other hand, you need private equity firms that are capable of delivering that. And that's where I think there's a profound shift underway in the global world of private equity, especially in India. And private equity firms are increasingly positioning themselves as providers of not just capital, but these kinds of value add. A complete business transformation, a complete business building solution.
Sanjeev, from a regulatory point of view, is everything sorted out, or you think we need better regulation, more tailored to and for these kind of investors and investments?
I think again, I'm pretty happy with all the changes that the government has made over the last 18 months or so. I think all of them have been on the right path, and most importantly, the one thing which sort of I would seek as an investor is there any uncertainty, and I think that's been taken away. Whether it is in terms of the tax regime in the country, whether it is in terms of how I manage some of my investments. There was this huge issue about what's going to happen about my infrastructure investments. Do I get the clearances? So many projects were stuck, etc. So the government has cleared all that up, and of course the big issue on the tax side has been cleared up, etc. We know what we can expect in the future, what an exit is going to be like, because for the investors, and Gopal can talk about it, I mean, it's not just about making an investment, it's about how I can exit it in 5 to 6 years time, whenever the time comes.
So that stability has to be
absolutely
there.
And if I have clarity about that, and I think this over the last 18 months or so, I think we have been headed in the right direction.
As Indians, we must accept that India is still an incredibly tough place to do business in on a day-to-day basis. And the single biggest thing that we can do to make business easier in India is to invest in judicial infrastructure. You cannot have a thriving system of commerce unless and until there is law and order. These are perfectly correlated, commerce and judicial infrastructure.
Fair enough. Just one last question. I mean, when you work with entrepreneurs, and you can sort of give us a few examples as well, how open is a typical Indian business owner when he kind of gets in touch with a private equity or receives money from a private equity fund to put processes, systems, etc. in place?
20 years ago, that we were typically dealing with family-owned businesses. And today, our typical entrepreneur is a first-generation entrepreneur who typically has, best-in-class education. So culture is increasingly defined by education. And this new culture is far more receptive. There has been a discernible shift thanks to the evolution and profile of India's entrepreneurs. But within that, there are always variations.
Gopal, Sanjeev, thank you very much, both of you, for joining in on this enlightening conversation. Thanks indeed.
Thank you.
On that note, that's all that we have for you on the second edition of PwC Presents The Winning Leap in association with CNBC TV 18. Through this series, we've met with stalwarts across industries to analyze and break down vital issues that impact India Inc., from how businesses create value, the strategies and opportunities that are imperative for their growth, and the various challenges they face in India's economic environment. Thank you very much for watching, and do join us for the next season. That was quick.
Yeah, Mark, don't worry. I'm driving on the new expressway and it's absolutely safe.
Focus, ideate, innovate, enable.